Hi everyone, welcome to our webinar series today. We are going to wait a few more minutes before we begin, just to let a few more other people join. So we will begin promptly at about 1:03 or 10:03 for those on the West Coast. All right, welcome everyone to our ASC 606 webinar series. We're going to talk about SEC disclosures, the year in review for 2018. Today I'm going to go through our short agenda first. I'm going to introduce SOFTRAX and Effectus Group, and then we're going to really focus on some key trends for ASC 606 and those early adopters, as well as the standard adopters. We're going to talk about key observations, some lessons and challenges in 2018, and even show you some benefits that companies found in 2018. And then we'll walk through some ASC 606 new developments and recommendations for 2019. Now, a couple of housekeeping items before we really dive in. You are all on mute. However, if you have any questions, please feel free to submit them in the questions or the chat box. I will be monitoring it throughout the presentation. And if we don't have any time at the end to answer those questions, we will certainly reach back out, and either someone from SOFTRAX or Effectus Group will reach out with an answer to you as promptly as we can. This webinar is for CPE credit, meaning you have to stay engaged for 50 minutes and answer the 4 polling questions when they come up to receive that credit, and you'll receive your certificate in a follow-up email as soon as possible. Okay, so to introduce today's presenters, my name is Kristen Lawson. I am a certified public accountant here in Massachusetts. I was formerly a consultant at Deloitte, and I worked with a broad range of companies, healthcare, life sciences, technology, investment management firms, and now I am a sales engineer here at SOFTRAX, assisting in the pre-sales process, focusing on our ASC 606 and revenue management solution. And I am joined today by Graham Holm, who is our Vice President of Product Management. He has a strong background with complex business requirements across tons of industries, from startups all the way through Fortune 500 companies, and we're very lucky to have him on our product management team. So before I introduce Matt, actually, I'm going to walk through a little bit about SOFTRAX, and then I'm going to hand it over to him to give you his bio. So just a little bit about our company. We are based in Massachusetts. We are a division of a larger company called AFS Technologies. We have pioneered the automation of complex revenue recognition. We have over 800 deployments with 0 failures. We are actually almost on our 5th generation of architecture, which will come out very soon. That's very exciting for us. And it's specifically designed to handle complex revenue recognition. And we have offices all over the world to support a ton of clients, everywhere from traditional software and SaaS clients to e-commerce, telecommunications, healthcare services, a lot of notable clients there. All right, so on to Effectus Group. I'm going to turn you over to Matt, who is our esteemed panelist alongside us. Matt.
Thank you very much, and thank you everyone for joining us on the webinar today. I wanted to just take a few minutes and talk about Effectus Group. Effectus Group is a Big Four, or everyone at Effectus Group is formally Big Four. Typically, you had to have been rated a 1 out of 5, with 1 being the best, to apply to our firm. And the reason we do this is because we primarily focus on very advanced technical accounting issues as well as IPO prep services. Within the technical accounting, we've performed approximately 120 revenue recognition ASC 606 implementations. And by this, I mean we're doing everything from writing the technical memos, oftentimes 30, 40-page technical memos on ASC 606 for a company, as well as helping out with the implementation of the IT systems and being the liaison with your auditors. And since all of us at the firm have former Big Four accounting experience, we're able to speak their language. So very happy to be on this call, and I'm looking forward to getting some feedback from all of you on the poll questions. Thank you.
Yeah, thank you, Matt. We're very happy to have you here today. Okay, so to start us off, I'm actually going to launch our first polling question. So you'll have about 30 seconds to answer this poll. Please let us know which of the following best describes your company's status to meet the requirements of ASC 606. And the next slide that we'll show you after we grab these results will actually be what we saw in 2018, and we'll do a little comparison. All right, so I'm going to give you guys about 10 more seconds to answer, get as many votes in as possible so you can all get credit. Okay, let's close that poll and share the results. All right, so it looks like we have almost 50% have fully adopted ASC 606, and then we're really close with partially complete and then implementation. All right, so let me go ahead actually and show you guys the next slide so you can see the comparison to 2018. All right, Graham, do you have anything to share about these polling results?
Well, it looks it looks like we're going in the right direction. So I think compared to, just to set context, we, through the beginning of November, we did a number of polls and surveys of prospects, customers, analysts, companies, any company we could get in touch with, and these are the average numbers that we received. As you can see here, we had a jump here in terms of adoption fully complete. We were just about 32, maybe 32.5% through, let's say, the end of October, and as we would expect, there was progress, and it looked like we were almost at half, or 48, 49% based on the poll results. So trending in the right direction there, and obviously with the private effective date hitting, and et cetera, there was more drivers there. But no, it's good trend there. Matt, I don't know, anything that you take away from this?
Yeah, my comment on this is it's a great trend. I definitely think, though, that the 80-20 rule applies here. The last 20% when trying to get these implementations complete is the most difficult. So I would definitely allow some time within your timeline for that 20% to be completed, because it does take longer than expected.
Okay. All right. Thank you to everyone who answered the question. Next, we're actually going to talk about some key trends from 2018. And the first thing we're going to talk about are early adoption. So per a report from Rob Peters at Intelligize, he summarized some key data points about these early adopters. So Graham, I'm wondering, whether or not you have some insight into, why the implementation was broken down this way, why you think most people chose full retrospective versus modified, and then Matt will ask you the same thing.
I think this report was highly valuable from our standpoint, and much of it aligned with what we were getting anecdotally, and then obviously doing our own surveys and polls, et cetera. I mean, the number of early adopters there weren't that many, obviously. You can see only 32 out of 4,000 public companies early adopted prior to 2018, right? And you can see the breakdown here. And so there's, when you look at it, there's, about a 47%, let's say, rounding up a bit, that went with full retro versus modified retro approach to adopt. One of the things that the report put forward and that we heard from early adopters compared to standard adopters was effectively, on the early adoption side, there wasn't a consistent theme in terms of why people early adopted. There were some general categories that we could, in responses that fell into categories. So one of them was, companies would say they wanted to get ahead of the curve to show regulators, to show the market, and in some cases, they saw it as a competitive advantage to get ahead on adopting 606. And so that was one reason. Others said early adoption might minimize the cost of the implementation, which was interesting. And then I think in other cases, depending upon the size of company, for a company that was, let's say, in its beginning stages and they were just starting with new customers, they had the ability to adopt quicker than obviously a long-standing company. So all of those factors went into the full retro number, and we'll see it in a moment, being much higher as an approach for early adopters versus those that adopted on the standard timeline. Matt, anything from your experience that you saw that either align with this or maybe explain this in greater detail?
Yeah, another reason for the early adoption could be if the company's planning on making some changes in the future, so they have other projects in the pipeline that they know are coming, and they just wanted to get this handled so that they could focus on other activities, for example, mergers and acquisitions, each of which may be subject to 606, which we'll talk about later in some of our slides.
Thank you, guys. I think that's a really valid point. It's nice to think that some companies get ahead of the curve rather than just kind of try to slide in on compliance there. So to dive in a little bit further sort of on these 32 early adopters, some more data points per this Intelligize report, the SEC issued comment letters to approximately 1/3 of these 32 companies. And then of those comment letters, they covered 18 topics, and 70% of the comments were focused on the measurement of performance obligations. So, in consideration for those early adopters, Matt, what do you think these comment letters were about?
Yeah, so the fact that companies receive a comment letter, isn't so bad in itself. It's more the content of what's in the letters, right? If the content in this last bullet point says 70% of the comments were focused on the measurement of the performance obligation, that's interesting to me because it speaks to potentially timing of revenue recognition. When the standard first came out, there was a lot of focus over the identification of the performance obligations, and we're still seeing comment letters about that as well. But the fact that these comment letters were about the measure of the performance obligation, to me, shows that there may have been some inconsistencies of practice within the industry and or within specific industries, for example, technology. And these companies are getting responses or getting letters and providing responses so that the industry can be level set in how certain types of performance obligations are going to be treated.
Yeah, I think that's a really good point. Graham, do you have anything else to add?
I'd quickly add on this one. I mean, Matt touched on all of the key points from my end. The only thing I'd piggyback on that is when we read through a lot of the comment letters, it at least from my read, is that in some cases, there were about 3 companies out of the early adopters that received multiple rounds of comment letters. And in some cases, to Matt's exact point, it almost, in some cases, struck me, again, I could be reading too much into it, but to Matt's point, it wasn't that it was punitive as much as, in some cases, it felt instructive with respect to the comments, the company responding, and then follow-up comments from the SEC. And it was touching on areas that the SEC and FASB and others had said that the standard really aims to address. So, looking at the comments and the responses in that lens, there was a lot of value in those activities, and it wasn't inherently negative, so to speak.
Yeah, I certainly agree. I don't think that comment letters were meant to be a negative, and maybe it does come down to those varying industry guidances or lack thereof, maybe.
Yeah,
okay.
I mean, it's important to remember, right? The whole standard is, what we always say this now, the principles-based standard versus the prior standard was all rules-based. So now if you take this principle-based standard and try and apply it to every industry, the only way you really get a clear indication of how that standard is going to be articulated in the industry is through these types of disclosures.
Right. Yes, I totally agree. And on this slide that I now have up here, and we're talking about that breakdown of early adopters and what type of method they used for implementation. Perhaps that's also an indication of their industry or their standards or the complexity. So Graham, did you want to talk through this slide a little bit?
Excuse me. Yes, I think it harkens back a few minutes ago to when we were talking about early adopters. About half, let's say, went with the full retrospective, and then obviously that number went down significantly, as you can see in the bottom bullet here. 87.5% of the S&P 500 standard adopters either adopted or plan to adopt using the modified retrospective method. And so that was per the Intelligize report. And then also when we talk to our customers and prospects, one of the things that, we were able to get, I think, 3 primary themes out of those conversations in terms of why folks went with the modified approach. So the first theme was time, right? In terms of as the due date got closer and then effectively took hold, the ability, at least from a company standpoint, to adopt using the full retrospective method, whether it was real or perceived, was compromised in terms of all the tasks they felt were necessary to properly do that. So inherently, they defaulted to the modified retrospective method. That line of discussion, held true, and I'd say, 9 out of 10 conversations, we'd start the conversations with that. I think the other line of discussion that we would hear from companies was resources. And what I mean by that is for a full retrospective adoption, when the finance and accounting team looked at all the pieces of information, the number of departments and the number of people that they would need to touch, the thinking was to do it in a full retrospective way. We don't have the runway to do that because we're so close to the date. And consequently, Modify gave them a better chance to keep those activities as much as they could within the confines of the group, if those other teams weren't available. And then thirdly, I think source information for the full retrospective, there were questions that companies had, not that they didn't have the data needed, but that getting their hands on it in a timely way and making sure it was accurate, cleaning it, doing whatever you need so that you could do the full retrospective approach. They saw that as an inhibitor at times to being able to adopt, with either early, obviously, they passed that point, but then also do it with a full approach if they were a standard adopter. So I think those were the 3 themes that we saw as we engaged with our clients, our prospects, et cetera, and it seemed to align with some tenets of the Intelligize report. Matt, did any of those align with what you've experienced with your clients?
Yeah, I would say all those aligned definitely with the experience that we've had with our clients. To kind of add some additional narrative on it, a couple things to think about is the level of granularization of your data within your current system. Your current system may not be capturing the information at the right detail level. in order to effectively do a full retrospective adoption. In addition, if a company elected to use the modified retrospective in that year of adoption, you're essentially keeping two accounting books, and you would want to consider whether or not your system's able to handle that, or if you're going to potentially even have to do it in Excel, and what type of time requirement would be required for that. So we've had some companies that have elected to do full versus modified because they thought maybe it's even going to take them less time versus keeping two sets of books in the current period. So it's not always that clear which method to choose. It's really being driven by several different factors. In addition to those factors, if, for example, you have a company that you're looking to IPO, maybe the full retrospective method right now would be better. That way, when you do your public filing, all the periods presented will be on an apples-to-apples basis.
Yeah, that's a wonderful point actually to mention. Mergers and acquisitions and upcoming agendas. But I'm certainly biased by the fact that you said it comes down to data, and now maybe that's my background as a sales engineer. But I certainly agree that everything's data driven, and you have to think all the way through the process before you can kind of make that perfect decision. But
yeah, I would say focusing on the performance obligations and looking at whether or not for each performance obligation, you have delivery dates, you have all the information that you need. We're finding that companies have more performance obligations than they had elements under 605. And as a result, when they start looking at their waterfall schedules, they find out they need to be expanded. And sometimes the systems can't handle that so well. So companies are either upgrading their system or putting it into Excel, which requires a significant amount of resource requirements.
Right. Oh yeah, that's a good point. Changing from 605 to 606, the number of elements and all the data points. Yes, right. We've seen that as well, for sure. So, and talking about, the breakdown of these performance obligations, something that companies had to deal with then was the disaggregation of those performance obligations and presenting them in their disclosures. And so one of the observations now that we'll move into and talk about were the different disclosures and the information presented in the financials. And so here we have just, a list of some of the sections that companies frequently use to present the ASC 606 information, and you can see they kind of bucket it into revenue, which seems appropriate, but also sort of recently adopted accounting pronouncements or standards, and then summary of significant accounting policies, as well as an impact, broad impacts of recently issued accounting standards, and then those notes and footnotes on revenue recognition policies and financial results. So Graham, what do you have for me on this topic?
I mean, I think it goes back to a key point Matt made a minute ago, which is it's a principles-based approach. And while there were examples put forward in 606 in terms of, how you should handle it, in terms of how it should be specifically presented in filings and in financial reports, that to me, to an extent, it felt like a new frontier. And what I mean by that is if you were to look at filings from a year ago, and then looked at the mid-year and then at the end of, obviously, going into 2019, you would see some differences, at least in my view, in terms of what we were seeing. At the beginning of the year, you would see the same information listed in multiple sections. So, for example, in, let's say, recently adopted accounting pronouncements or recently adopted standards, you might get a long narrative as to what the company's doing to handle 606, and then it would be repeated in a note section, let's say revenue recognition or revenue recognition accounting policy. But you wouldn't get anything necessarily new. It would just be effectively a cut and paste. Whereas now you're seeing more targeted information presented strategically throughout the filings for those companies that had a few quarters of activity and as they've gotten more comfortable. And so the disclosures are longer, but they're longer with a purpose, at least in my mind, and in a lot of cases for companies that have had time to get to that level of maturity. And so you're not seeing as much repetition. And so, I mean, those are some key takeaways that if you were to compare, the beginning of the calendar 2018 to the end and now, what you would find. And, we'll talk in a few minutes about more details related to that, but definitely what I would say as well, and handing it over to Matt, is telling the story has been more of a focus in these filings than the initial set where it was endpoint driven. Now it's telling how they reached that endpoint. The companies are in terms of a qualitative narrative story, if you will, that explains the numbers so that in terms of 606 and the impacts, and even if there's no material change, I think that's been a progression over the year that's been very important. Matt, what have your experiences or any thoughts on this particular piece?
I would just say as a best practice, I would take each one of these bullet points and put it into Excel, and then have one of the cells be like put it into a matrix and have a paragraph for each one that describes what you're doing. Because what I see a lot of the time is just corroborating information, or basically like you were talking about the story is saying two different things depending on what section it is, even from recently adopted accounting pronouncements to the summary of significant accounting policies. I've seen differences. So I think if you put it into a matrix in Excel and then just read it all in one place and make sure that messaging or story is consistent throughout, that's going to be a really good best practice.
Yeah, I actually really like that idea. You know, maybe again, I'm biased and I love Excel, but even just looking at this next slide of observations that we have here, a Deloitte article was published and it said that revenue disclosures were up to 3 times longer than prior year disclosures, as well as, you know, the diversity and the type and amount of information that entities were disclosing. So I think I agree it may help to organize disclosures and organize, you know, where those thoughts need to go. If you put it into some sort of matrix and file it out by category, or make sure that it's all corroborated. Matt, do you have anything to add in terms of what this Deloitte article says?
Yeah, I would say just look at all the big four. So this is the Deloitte article, which I think is completely correct, 3 times longer than prior year disclosures. But like KPMG has a good disclosure guide as well. Just use it as a checklist to make sure that you're covering everything that needs to be covered for each one of those sections, because it really does take more time than expected to write out these disclosures and make sure they're, for example, consistent with what your competitors are doing as well, right? You don't want to disclose more than your competitors and potentially put your company at a, you know, at a disadvantage. So all those types of things are important to consider.
Sure. Graham, do you have anything else to add?
No, I think we covered the key points there. Both of you said it quite well.
Awesome. Okay, well, next up, we're actually going to go for our second polling question. So again, please, once the polling question is launched, I'll give you about 30 or 45 seconds to answer the question, and then we'll go through the results briefly before we compare to last year's results. The question is, which ASC 606 disclosure requirements is most complex and or challenging for your company? So we're sticking with our disclosure topic. Okay, just a couple more seconds and then I'm going to close the poll and we'll collect those responses. All right, let's see what our results gathered. Okay, so we have almost 30% into the presentation of contract balances, and then closely followed by significant judgments determining the transaction, the timing, and then 20% at disaggregation of revenue, and 14 and 7 in the latter categories. All right, so let me go ahead and post those results from 2018 and we'll compare. All right, Graham, what do you have to say about this comparison of results here?
It's interesting. In what we saw in 2018, you can see obviously at the bottom, disaggregation of revenue. You know, that was the leader, and to an extent that came down a bit in this round. I think this aligns with our, I would say, the review in terms of the presentation of contract balances, contract assets, contract liabilities, etc. We've heard that more, so the responses align with that, and we're seeing, and to my point a moment ago, as you moved over time in the calendar year and looked at filings, you would start to see, if you were to compare the filing of a particular company at the beginning of the year to a filing toward the end, you might see in some cases the presentation of contract balances put forward as a separate section, whereas at the beginning of the year, whether it was because of the comfort level or lack thereof, it wasn't called out as such. We're starting to see in our reviews more distinct called out presentations of contract balances and then a narrative around that. So these results seem to align with that, and then that would be one of my takeaways. Matt, any thoughts on the results, comparative results, or what you saw in the result today?
No, I think the results are very consistent with what we were expecting, like you said. So that's all I had on this slide.
Okay, thank you.
Okay, great. All right, so to jump into the next topic here, we're going to go through a few more observations. So we see the most frequent attributes used to disaggregate revenues were products and product lines, as well as geographical and business unit per our review, as well as some of the revenue disaggregation information was frequently separated into specific sections. And per the Deloitte study we spoke of earlier of sampled public entities and SEC filings, 95% of disclosed revenue disaggregation information was in a tabular format, 60% were by category in a newly incorporated revenue, and 20% information in the segment footnote, 20% disclosed for newly adopted accounting pronouncements section. So following up, we actually will present you with some charts so we can show you some of the presentation. But before we jump into that, Graham, do you have any comments on this slide?
No, I think if you jump to the next one, I just want to piggyback on that visual. So what this shows, to correlate it back to the previous slide, I think is interesting here is that similar to what we saw is throughout the year of progression in the filings, but and how companies presented the information in terms of disaggregating revenue. And you'll see this was just taken from a particular filing from 2018. It was representative of just an approach to present it. And you can see, across the top, we have the operating segments with, a specific range of time. And then you have products and the types of products and services on the left. But then taking that same information but presenting it just a slightly different way, you can see the company also did it disaggregated it by revenue recognized over time versus a point in time. And so it's interesting because that second section wasn't as prevalent, at least in the first half of the year from our reviews, but now we're seeing it more in the filings. And it's, I think, leading up to the presentation of the disaggregation of revenue information, companies typically throughout the revenue note section of the filings, they tell the story. They explain what the performance obligations are. They explain their operating segments, and then they explain how the revenue is recognized and why it's recognized that way, and then cap it with a quantitative approach, such as what you're seeing on the screen. So definitely have seen what I call a progression over time in terms of getting to this point of a quantitative presentation and preceding it with a narrative. Matt, is that something that when you work with your clients, you see a lot in terms of how companies are building up to the endpoint and presenting the information, or any unique presentations that you've come across of disaggregating the revenue?
My comment on this slide is that I like to see the tabular format. Sometimes the written out format, it takes a long time to update. So when you think about in the future for each one of these 10Q filings, updating it, this is a much more streamlined, efficient way of doing it, particularly if you're using, one of the software programs out there, like Workiva has a software program for 10Ks, those types of things. It makes it much easier to update and much less prone to error than if you're trying to pull numbers out of paragraphs and change them. I've just seen so many errors in those type of situations. So I think these types of presentations are really good in a tabular format.
Absolutely, absolutely.
Guys, I actually just had a good question come in that I think you guys can speak to. Have you seen companies disaggregate revenue in different ways depending on their reporting segments? So for example, product type for segment A and customer type for segment B. Matt, do you have any experience with that?
Yes, you would break it out. The SX requirement, not to get too technical, so we're talking about two different things here a little bit, but there's an SX requirement that you report revenue by class and by segment, and then you would have the 606 requirement that you're reporting revenue essentially by performance obligation by class. That's also incorporated into the disclosure. So I can completely see companies having to separate out their revenue that way, and I think it's a really good internal process to go through to ask yourself, how do you want to represent how your different products are being sold within the scope of 606 as well as the SX rules, because it probably has not been. Companies oftentimes just roll forward, what's happened last year, and so this is the perfect opportunity to take a new look at it and make sure that it's disclosed in the way it should be.
Yeah, I think that's a good point. It helps you break it down, and to your point you made earlier, it will certainly be easier to update if you use this tabular format. So we'll actually take another look here at a different example of that tabular format for this income statement, and it says companies frequently presented quantitative information on financial statements in a format where pre-ASC 606 and post-ASC 606, as well as the impacts, were represented as separate columns. So Matt, do you have any comment necessarily on this specific slide?
Yeah, so let's just add to the example we were talking about. So if, for example, a company also sold hardware, then the expectation would be that hardware would be a separate line item here under revenues. So all those different classes of revenues, you would want to disclose separately to the extent that they're material to your company.
Yeah.
And that's all I had on that slide.
Okay. Yeah, I remember writing memos when I worked at Deloitte, and if we didn't put things in charts, it was so frustrating to write out all these numbers separately for separate lines and then aggregate them. And anyways, I digress. Graham, do you have any comment on this slide?
The only one I would make is I think it's one of the things that it goes to the point that both of you just made. I think there's a lot of value in the filings in terms of the narrative for each product class, and I've seen that quite a bit. So by the time you get to this, if you've read through it, if you read through it, you have good working knowledge as to what each row represents. But I still agree that at the end of it, most people, depending upon their level of interest, and if they're just looking for numbers, tabular is the best. I have found, though, that you're getting more and more qualitative information to support the quantitative presentation in the tabular format. And once you read that and then come to this section, it does give you visibility that otherwise you might not have pre-606 in terms of understanding the business, in terms of what business unit sells what, how the product's delivered, and how the company considers the performance obligation satisfied. All of that in many cases precedes this presentation, so it's a pretty comprehensive picture at that point.
Yeah, and I just pulled up one more slide we have to represent that quantitative information. So Graham, do you have any other commentary in regards to the specific picture?
No, I don't. The only thing I do, because if I didn't, I wouldn't keep talking. So I have one quick point is that what we're seeing a lot of is in addition to the tabular format, notes at the bottom of the section that call out any discrete, I guess, note or key piece of information that they want the reader to keep in mind related to 606. So even the column titles, they might have it in there, but then after it, there might be a note in there that is a reminder of a key qualitative point that that would help their interpretation of the numbers. And many times they do that, and I've seen it in a lot of cases with a modified retrospective approach, where maybe there was an impact where numbers look different, or the comparison there's an unexpected impact, and so they're reiterating that with a short note below with an asterisk in a particular cell, just so that when the reader goes through it, they can correlate it back to the narrative earlier in the document. Matt, I don't know if that's something that you've seen with any of your clients or come across, but it's something that we have.
Yeah, that's consistent with what I've seen as well.
Okay.
Okay. All right, so to kind of switch gears here a little bit, we're going to move over and talk about practical expedience, which we have also talked about in the past. And here on this slide, we're just saying companies frequently specify that they used more than one, perhaps, practical expedience in the application. And while companies typically provided qualitative input on why they were eligible for expedience, they also provided that quantitative information. Or they did not, excuse me, they did not always provide that quantitative information. And per the Deloitte study, most entities in our sample elected multiple practical expedients related to their disclosures, most commonly those related to remaining performance obligations. So maybe this actually goes back to that initial point that Matt made about measurement of performance obligations and where those comment letters were commenting on them, but may not have been negative. It just may be that they chose to choose this practical expedient and they needed to provide some more disclosure around it. Matt, do you have anything to say about this?
I would just say that when we talk about practical expedience, there's quite a few in the accounting literature, and companies are going to want to read them very closely to determine whether or not they apply to the company specific circumstance. The way that practical expedients are written, some are written very narrowly and others are a little bit more broad. So it's important to really understand them and to look at examples of the practical expedient being applied, whether it be in the KPMG guides or in the Big Four accounting guides like KPMG, or through these public disclosures.
Okay, and then Graham, do you have anything to add?
I don't have anything to add directly on this slide, but when we transition to the next one, there's a direct correlation, and I think my comment can cover both slides in terms of, we noted these as the three that were frequently referenced, but as Matt noted, there's many practical expedients. The one thing, and Matt touched on it earlier, and I want to circle back to it, the one thing that became evident as comment letters in 2018 came out was that when companies had, let's say, conflicting or discorroborating information in terms of, let's say, for example, within the filing, they made a statement, qualitatively, that they have long-term contracts. This is an example we saw in a few instances. And then they go down to a practical expedient, and they basically say, well, significant financing component or another practical expedient, which basically says that anything that's 12 months or less, you can select and use that practical expedient, and they took advantage of it. But there was that conflict, the FCC's comment letter asked for clarity on, well, above you said you had a long-term contract, and how can you select or use this practical expedient? And so to Matt's point, and earlier, and what we've seen is, I think that's a key area that companies have to be very cognizant of. Now, if it's what we saw in responses is that company would say, yeah, I have a long-term contract. We have long-term contracts, but it's not material. But if you're stating it qualitatively, to an extent, you're on the hook to either explain it, whether it's material or not. But even if it's not material, you have to go through and I think provide that narrative. Otherwise, you could get a comment letter inquiring about it, and avoid that disconnect between what you've stated throughout the filing, or even in a private company case when you're working with your auditor and then electing a practical expedient, making sure that justification is there. Matt, is that something you've run across with companies to date?
Yeah, and it's getting into the application of the practical expedients, right? Definitely have ran into that. I would say this last practical expedient, just ASC 340, it's important to read it very closely. There's a practical expedient. If your amortization period for costs would be 1 year or less, then maybe you don't need to capitalize those costs. Well, companies are oftentimes confusing amortization period with contract periods. So let's say you're a SaaS company, annual contracts, they say, okay, I'm going to apply the practical expedient and move on. That's actually not what that practical expedient was for. So it's really important to read it again carefully. I want to just reiterate that again on this slide, because I feel like there's just so many mistakes being made out there related to these applications of practical expedience.
Okay, yeah. All right, so, as we move on then, sort of in line with practical expedience, and the disclosures, and in line with the implementation and adoption, companies required more time and resources than companies anticipated. So these are some of the lessons and challenges that companies learned in 2018, as well as, it's a complex standard with a large footprint. Many of them had to apply those significant estimates and judgments, and those disclosure requirements that we were just talking about introduced tons of complexity at a higher level of effort. And not to discard this this slide, but just to make sure we keep moving, I just want to give you a full picture of our lessons and challenges, and then we'll ask for commentary in a moment. And then, so allocation and standalone selling price requirements, those were huge, as well as contract modifications and variable consideration. So just to pause there, Graham, do you have any comments then on those lessons and challenges so far?
I mean, those two slides, we could probably do a webinar just on the experiences.
Yeah.
And I know we have a hard stop at the top of the hour, so I won't. Now that I have people who want to listen to it, well, maybe that's a strong term, but I'd love to pontificate. But no, I think, in all seriousness, I think marrying the first slide with this one, I think the biggest thing, the takeaways were, a couple things. One is, because this set of revenue guidance went across industries and introduced requirements that effectively leveled the playing field for everyone, if you just click, Kristen, to the next slide briefly, where it had the 3 points, things like allocation and standalone selling price requirements, yes, there were industries that had the concept of VSOE, like software, for example, the software industry. But you couldn't necessarily just take that in its form as stood under 605 and drop it in 606 and just, rub your hands together and say, I'm done. So even if it wasn't net new, there was a certain amount of work involved to ensure that what you're doing today lines up with what you're doing, what 606 requires. But beyond that, and if it's net new, obviously there's challenges there. The other piece, and we talked about it, is just the footprint overall, meaning contract modifications. If you're the type of business where you sign a contract with customers, but then within a given window of time, there might be amendments to that contract. There might be additions, subtractions, changes, whatever the case may be. And if there are price changes or scope changes, typically, in the past, you may not have had as many considerations as you may have under 606 in terms of how do I handle that correctly under 606 for contract modifications, and how do I do that in a repeatable way? And so this gets into, and Matt touched on it earlier, do you have this data in your upstream systems to support these things? And if you don't, then you have to open up the approach. So I would just summarize all this by saying that these are really, the lessons and challenges are really, when you go into the weeds and you start to go through, all right, how are we going to handle this as a company? That's where you start having more people in the room to handle it than just the accounting and finance teams. Matt, anything to add here?
No, that's all I have.
Okay.
Yeah, that was a very comprehensive assessment, Graham, for sure. And on this next slide, we even note that based on our review of SEC comment letters, the following areas were frequently targeted. So determining the transaction price, allocating it to performance obligations, contract balances, performance obligations, so a lot of the things that you just touched on, as well as a lot of the things that we have touched on previously in this webinar and in past webinars. So I think that was a good comprehensive look. And okay, so we do have about 10 minutes left, and we have another polling question coming up. So again, I'm going to launch this poll, and I'll give you about 30 seconds to answer before we go into our next section. So what areas of your company were most impacted by ASC 606's requirements? Please select all that apply. And I think this certainly goes back to some of the other lessons and challenges, talking about preparation, implementation, and adoption, you know, all these different organizations and departments within your company that are being affected. All right, so I'm going to go ahead and close this poll and share those results with you. And again, we will discuss and compare to last year's. All right, so a sweeping majority came up with finance and accounting. Let's go ahead and see what we had last year. All right, Graham, what are your thoughts here? Looks pretty similar.
They are similar. The one thing I'll note when we go to the results slide, so it looks like the responses for sales and IT, those jumped a bit in our current inquiry compared to prior years because we're below 20%, whereas in our results screen a moment ago we were above, which would make sense as companies, you know, as more companies are adopting the standard, and even if they had adopted when they responded before, maybe they're moving forward with some additional approaches to handle it. So, I mean, my takeaways are that, you know, it's consistent. You know, finance and accounting is a given, but it looks like an increase in sales and IT here.
Yeah, Matt, do you have anything to add?
No, I think Graham did a great job describing that, those results.
Yes, I agree. Okay, so moving on, I mentioned we were going to talk about some of the benefits. So, you know, we've been harping on some of the challenges that companies have faced and the lessons they've had to learn going through much of their implementation, but we did want to highlight some of the benefits that companies have received. So overall, companies are better informed about their end-to-end contract to revenue processes. And here are some bullet points that kind of summarize a bit of what companies have learned in that regard. So Matt, can you speak to some of these bullet points?
Yeah, I would say that this is a real opportunity. I would almost jump to this last bullet point here, commission and bonus policies. So typically, if you think about the life cycle of a company, the commission plans, they start with business development and then they kind of get updated over time with inside sales, outside sales, but they never actually get replaced. So I would say this is an opportunity to use the accounting terminology is to supersede and replace your commission and bonus policies to make sure that they're as streamlined as possible. One of the items that I ask companies to do sometimes is tell your CFO or CEO how many hours a month or a quarter the accounting department is spending just calculating these commissions and bonuses. And sometimes the number is pretty unbelievable to hear, and usually the C-level execs don't even know that it's taking that much time to administer those policies. So this is a perfect way in order to create some leverage to make some changes in your commission and policy programs, as well as in the your IT area. A lot of companies that are adopting 606 this year are upgrading their systems to a new accounting tool, and so this is the perfect way to use the new standard as leverage in order to update the tool. And it's also a way to decrease, hour requirements later or resource requirements later related to the upkeep of 606 in terms of the monthly, quarterly, and annual reporting requirements.
Yes, I think that's extremely true. You can talk about the broad effects that it is for maintenance from an IT or systems perspective, but then the real meat of it is down in those specific opportunities to update policies. Correct. So improvement for commission is a great one. Graham, do you have anything else to add?
No, I don't have anything else. Matt said it once and he said it well, so I won't ruin it. No, that was I'll summarize.
Thank you.
Okay, great. All right, so we are going to then move into new developments that we want to talk about, from January and maybe a little bit from December from 2018 and 2019, and then we'll talk about, what's coming up in 2019 and some of our recommendations moving forward. And we will try to keep it under 3 to 5 minutes, so we won't keep you over. So first, those new developments. So companies need to keep in mind that mergers and acquisition activities could introduce another round of ASC 606 adoption and implementation requirements. So I'm actually going to let Matt start off with this one because he did mention those merger and acquisition activities earlier in the webinar.
Yeah, so my comment here on the mergers acquisition, I'll just make it real quick in terms of time, is make sure to work with your auditors about how an acquisition is going to be impacted by 606, because it could be that the deferred revenue that's, let's call it acquired during the acquisition, may not need to change under 606, but new business from the company that is acquired may need to be under 606. So definitely work with your auditors. We've seen companies make a number of mistakes around M&A activity and the implementation of 606.
Awesome. That was very quick. Graham, anything to add?
No. I on the next one I have something, but I think Mac, both of you covered it well.
Great. So then on to the next one. We are going to talk about, some material weaknesses that were found in some of the filings. So I just want to highlight kind of what's at the bottom here. The company concluded these errors resulted from a material weakness as it did not maintain effective controls over the adoption. So in some specifics up in the above paragraph, including gross versus net presentation for payments, incorrectly applying the guidance for contract modifications. So Graham, what can you tell us about this slide?
I mean, I think with respect to this one, what the takeaway was, was striking in that some companies couldn't get through the first fiscal year under 606. They went 1 to 2 quarters in and realized they had to restate, and then that opens up obviously a number of other issues as a result of that. But then when we look back, or I look back at some of the polls and input we had received in 2017 and going into 2018, and the fact that many companies hadn't started based on their results, or that they were still implementing, post the let's call it the due date, it's not necessarily surprising, but it was still, it still strikes you when you look and there are companies that couldn't get through year 1 of 606 without having to restate, and there were over 24 companies based on the article we identified from Compliance Week. So it was a striking statistic in my mind. Matt, I don't know if, from your standpoint, anything to add there.
No, I think you definitely covered that very well. I have nothing to add on that one.
Okay.
Awesome. Okay. So then we're going to move into our recommendations for 2019. So Graham, what do you have for, what did we learn? How will we apply it moving forward?
I think I'll make it quick, just knowing time. I mean, I think ultimately one of the things that the slide covers most of it. What I would say is, all of these activities are centered on keeping up to date with the guidance, keeping up to date with what competitors are doing, keeping up to date and keeping up to date with what competitors are doing. One of the things that has been very, in our view, instructive is looking at earnings calls transcript for competitors if you have, obviously if they're public companies, because the analysts are asking a lot of probing questions that can give you insight into the companies, not only handling of 606, but their business as a whole. But also, as more questions, transition questions, and questions go into FASB, there'll be updates we would expect on 606, or at least guidance. It's good, as Matt said, the auditors, the governing bodies, competitors, all of those sources can provide you with highly valuable information to keep maturing with 606.
Okay. Matt, do you have anything else before we launch our final polling question?
No, I don't. I'm curious to see on our final polling question the results, so let's definitely launch it.
All right. Well, it's up. So again, you guys have about 30 or 45 seconds. Don't forget, you do have to answer this question before you have to log off if you want CPE credit. Again, I'll give you about 30 seconds and then we'll close it out and gather those results so Matt can comment on them. Okay, a few more seconds here. All right, let's close it out and let's see what we have for our results. Okay, so what do you expect will be your company's biggest ASC 606 challenge in 2019? Matt, what do you think?
I think these results are really interesting. My suspicion is that the IT impact is at 24% right now. I wouldn't be surprised if we do the same poll in Q2 and it's over 30%, because what we're seeing is companies, the intricacies of their system are kind of coming back, and companies are finding out that there's different scenarios that are really impacting them, that are requiring the systems to be updated. So that would be my suspicion, is that number will increase. Also, the sustaining a high level of effort, I would think that maybe some of this 30% also goes into the IT effort as well. So I kind of view those almost as together, which is 57%. So there's still a lot of work to be done this year, and I would just encourage companies to make sure that there's a plan in place to have the right level of resources, to the extent possible. Get your budgets approved early, because it will come up, and oftentimes it comes up at the most inconvenient moment, i.e. like 5 days before the end of the quarter, that type of thing.
Yes, definitely don't want to run into the end of the time frame there.
Yeah.
Okay, Graham, do you have anything else to add? Otherwise, I can scoot over back to our presentation and we can walk through the rest of our recommendations for 2019.
I think that's a good approach.
Awesome. Okay, so we actually, talking about IT and systems, we did write a blog on best approaches for ASC 606 adoption and avoiding manual efforts and that brute force spreadsheet approach. So Graham, what do you have to say about this?
I mean, the bolded areas cover it, so I don't want to make the common mistake of just reading off it. All I'll say is this: I think based on all of our discussions with prospects, customers, analysts, etc., yes, there were a percentage of companies that were able to get some level of automation, but in many cases, it was the addition of hands, heads, and spreadsheets to get through the year one of 606, and we call it, and others have a manual effort, brute force approach. And so corresponding it back to our poll result, you can do that so long, but then you get fatigued. And as you get fatigued with the brute force approach, it introduces the risks and the challenges that we've articulated on the screen in terms of errors, security, it's not extensible, and then obviously it's not a reporting tool. So these are all things, and I'm summarizing, these are all things that we've seen and that we really feel strongly we can help companies with in 2019. And anything from your standpoint?
No, I don't have anything to add. I think it was very well said.
Awesome. Okay, then we have one more slide, I believe, of recommendations for 2019. So what level of risk is your company willing to accept with ASC 606? According to an independent research company, excuse me, Audit and Analytics, public companies see their market capitalization plunge by almost 10% when financial restatement occurs. And we did mention that earlier example of restatement. Another is private companies can see valuations drop, which can be devastating. So Matt, do you have anything to add to this risk for 2019?
I would say it's just very important to ask for help. If you're looking around in your accounting department, for example, and you don't have individuals necessarily that can sit down and write a 30-page memo for 606, then I think it's important to ask for help, because the alternative and the consequences of that alternative could be pretty devastating to the company in terms of their valuations and market cap.
Right. I think if companies do their homework up front, sort of what we've been harping on from the beginning, then I think that's a good approach. And perhaps that transitions us into our next slide, which Graham, I'll kind of ask you to walk us through, is a recommendation to maybe do a bottom-up analysis. So Graham, what do you have for this?
Yeah, I'll try. In terms of what this represents, and this is just one form of a template that can be used, but when we've worked with clients, prospects, et cetera, it's really looking at it instead of top down, really building up from the bottom up. And what we mean by that is identifying how much time, effort, hands, spreadsheets, what have you, are being used to manage new contracts, to amend existing contracts, and to update existing contracts per month. And then this particular screen is just showing you an approach where you can really quantify that. And when you quantify it, then you can correlate it to a cost. And then the cost obviously is both in real dollars, but then it's also an opportunity cost for the resources that have to do this type of tactical work where they could be doing strategic work. So this is a type of tool, and Matt, I can't speak for you, but I'm sure you might have seen tools like this in the past, but we encourage companies to do this bottom-up analysis when they're evaluating, do we adopt 606 in a proficient, effective, extensible way or not? And as our company grows, how can we handle it? And this transitions to the final slide, where it's really just, our position is really now is the time to automate. And so if you're a company that's, using many hands, using many spreadsheets, taking risks, the cost of our solution for Revenue Manager, it's a fraction of the cost of a lot of those manual efforts, and you get all the additional benefits of ROI, of full automation, security, effectively being able to hit buttons and produce output that your auditors can sign off on without having to go through 5, 10 spreadsheets, people, what have you. So we really feel strongly we can help companies, and it's a win-win for your company and you. And so we leave you with that today, as just a food for thought. It's something we really love an opportunity to work with you on.
Yeah, I think that was a great conclusion. So here are our upcoming webinars. We have a webinar for automation and controls next month, as well as one in March on complex revenue management. It'll be a customer case study, and then we have some additional resources there at the bottom and in the following slides. Again, if you need any of these resources, they are available for download in the handout section. If you are unable to download them or save them, please let us know. I'd be happy to send them to you after the webinar. I really want to sincerely thank you all for your time. If you are expecting CPE credit, you will get a certificate as soon as possible. I will be sending those out. And thank you so much, Graham and Matt, for your time today. I thought it was very well thought out and very well presented. So thank you very much. If anybody has any other questions, please feel free to reach out.
Thank you.
Thank you, everyone.